Hello and welcome to Rajya Sabha Television. You're watching The Big Picture with me, Frank Pereira. The Reserve Bank of India today kept its key lending rate, the repo rate, unchanged at 6%, dashing hopes of lower borrowing costs for households and the companies ahead of the festival season. The six-member Monetary Policy Committee headed by RBI Governor Urjit Patel kept one eye firmly on the rising inflation that is perilously inching towards the RBI's 4% threshold level. In August, the MPC had recommended a 25 basis point cut in the repo rate to 6%. Business leaders have been arguing for a repeat action to revive investment, spur spending and aid a turnaround in the broader economy's growth that has slumped to a 13-quarter low of 5.7% in April-June. The central bank and the MPC also made it clear that it stood firmly on the side of inflation control in the growth-inflation trade-off. On this edition of The Big Picture, we will analyze the takeaways from the RBI's status quo policy statement. Joining me on the program today are Nitin Desai, former Chief Economic Advisor, Government of India; Priya Ranjan, Senior Journalist; Renu, former staff member, RBI and International Monetary Fund; and SP Sharma, Chief Economist, PhD, Chamber of Commerce and Industry. Thank you to all my guests for joining me on this edition of The Big Picture. Mr. Desai, I'd like to begin with you. There was, the industry, several business heads thought that there would be a 25 basis cut as far as the interest rate is concerned. Were you surprised at all at the status quo decision of the RBI?
No, I'm not surprised. This is what the expectation was. And but it's not just the industry heads. I'm sure there are some people in government in Delhi also are not exactly happy with this, because many people have now gone on record saying that we need lower interest rates because the real rate of interest in India has now gone much too high. The general expectation is you should keep it around 2%, 3%, not more than that. So I'd say it's not just the industrialists. There are some people in positions of authority and power and influence who are also going to be upset. But was it unexpected? No. Almost every, if you like, practical economists, the economists who are involved in advising companies, etc., had said that they did not think this would happen, because what you have done is basically told the RBI, there's only one thing you are answerable for: what happens to inflation. If it goes beyond 4%, you'll have to explain to the country and to the parliament. And I always felt that it should have been some balance between that and growth. It's very surprising, their statement. On the one hand, they say there are greater risks of inflation, though it's not very convincing. Why? Because they say food inflation is okay, crude prices have seemed to have stabilized in September. I don't know why they have put forward a forecast where they expect inflation in effect to accelerate. And the same statement actually revises their growth projection downwards quite significantly.
Yes.
From 7.3 to 6.7.
Yeah.
And they say, and they not only say that, they say there are even chances on either side. If you look at the tone of their statement, they basically, the chances are more downside. So here is a situation where the MPC itself is telling us that between growth and inflation, you have told us to worry only about inflation, we will do that.
Sure.
And in fact, you look after growth. Only slight thing I would say here is, my feeling is that had they not had this growth downturn, I wouldn't have put it past them to raise the rate.
Okay. Okay. Yeah.
I wouldn't have put it past them to raise the rate by 25 basis points. So maybe that moderated this. At least let's not raise the rates, even though the inflation situation is getting worse.
Fair enough. Mr. Sharma, how does the industry look at all of this? Because clearly the industry wanted a rate cut. That has not happened. Mr. Desai is suggesting that they could have possibly increased the rate. So that is definitely against what the industry is looking for.
I think there was no scope to increase the repo rate, because now manufacturing growth rate is, I think, 20 quarters below.
So was there scope to reduce the rate?
Yes, there was a lot of scope to reduce the rate, because growth numbers are also decelerating. 5.7% is much below as anticipated for the whole year. But one thing positive is there, that RBI has not reduced that much the growth figures. Growth figures are still 6.7%. Means in the coming quarters, India's growth is going to happen 7% in the next quarter. If these figures are realistic, 6.7% will average out if the remaining 3 quarters are growing more than 7%.
So do you see that happening?
I believe RBI figures are always realistic. So if the growth remains at 6.7%, then we have good chances to grow in the much higher trajectory as compared with 5.7% in the quarter 1. So in the coming quarters, growth will be more than 7% according to this projection. But inflation, as anticipated by RBI in their policy statement today, will increase to the level of 4.2 to 4.6%.
Yes.
That is a worrying factor. That's why they have not reduced the repo rate. But if we have to revive our manufacturing sector or industrial growth, then the repo rate is high, still high, because ease of doing business is okay. But there must be costs of doing business are also rationalized. So that is the one factor that will help Indian industry to grow. Because the competitors are growing and their exports are also increasing, like Brazil, Indonesia, Malaysia,
Sure.
Korea. These economies are growing in the export trajectory, but our exports are also not growing. That's
Fair
why,
enough.
majorly because of the high cost of doing business, and ease of doing business is a major factor.
Okay.
So if there is some improvement in these parameters, like cost of borrowings are reduced and ease of doing business is improved, then we have scope to grow in the more than 7%.
Okay, we'll get to growth in just a bit. Let's talk about let's focus on the interest rates for the time being. Mr. Dash, low interest regime, is it a good thing or is it a bad thing at the end of the day?
Well, clearly means it's a no-brainer that you'll need a low interest rate regime. That's one of the macro parameters that need stability, like inflation, like the other important indicators. But that's the point. See, the point is in August when they did 25 basis point reduction, that time perhaps the scope was for 50 basis point. Now one should understand the policy rates are down to almost their historic low of 6%. So that's not very high when we in our Indian economic conditions. Now the real interest rate, if you look at now, Reserve Bank is talking about 4 to 4.6% inflation. That means the real interest rate is down to 1.5 percentage points, which is not the desirable. One always talks about at least a 2% real rate of interest. Okay. Now the other thing is, in terms of bringing interest rate down, bringing it down for whom? See, when we talk about a lower interest rate regime, a lower interest rate regime applies to both the savers as well as the investors, isn't it? Now, in the present situation, whereas the industry could be clamoring for a lower interest rate, that may not be so given the difficult economic and social condition facing vast majority of people who are actually don't get anything on their in their money, the money that they have in the bank. Post demonetization, the forced deposits that those have happened are getting channelized to through the mutual funds into the stock market, but there is no avenues as such for savings. It's a major disincentive. So savings rates are down. Right. One of the reasons why investment rate in the economy is down. That's dangerous. But the main reason why Reserve Bank of India is worried about inflation is not because food prices are rising or oil prices are going to spurt, but there is of course non-oil, non-food inflation that is inching up. But the main worries are coming from the fiscal policy slippages. Sure. Or fiscal slippages that are anticipated. Now, there have been talk about pump priming the economy. The economy is running on one engine as such, that is the government investment, public investment engine. No other engine is firing at the moment. And the scope of that is not very large, but there has been talk about it. There have been discussions to do so, and some promises that is coming. Number two, the state governments are now getting into a competitive spree as elections approach to implement 7th pay commission for their staff, which again is going to put there already some of the states, the state finances are no longer as good as they looked couple of years ago. So now that is again the problem, that the states would be landing up borrowing.
Right.
Third is the competitive populism in terms of loan waivers that are happening. So these things have actually, if they have not completely closed the door for an interest rate policy rate reduction, that to my mind, that window is closing very fast.
Okay, fair enough. Let me bring in Renu Kohli into the picture. Now, as far as the RBI is concerned, the reasons given by the RBI for not cutting repo rate this time around, do you think that they are valid?
I think, yes, certainly there is a lot of justification, and at the very outset, you have to see their baseline assumptions of their inflation forecast. First of all, the previous forecast in August was a very wide range of 3.5 to 4.5, and now the range is narrowed, but it's lies between 4.2 to 4.6. So there is a 10 BPS increase. Now, where is this increase coming from? One is that in the first half of this year, 2017-18, the assumption of oil price was $50 per barrel. And in the second half, their assumption is $55 per barrel. So, the global oil price, and including that of metals and other non-food agriculturals, as well as even global food prices actually, all of them are going to feed into domestic inflation henceforth. It has already begun, because we can see the 2 percentage point jump in the last 2 months in the CPI headline inflation. The second is the unfolding of the final outturn of the monsoon, that is now 5% below normal. Earlier, it was supposed to be above normal or normal monsoon. So, these are the two things that are impinging upon inflation. The third thing which feeds into the inflation model is the fiscal situation. Now, currently, they have said that the fiscal deficit forecast assumption in their baseline model is kept at 3.2% of GDP as before in April. However, the number of downside risks to fiscal slippages have increased. So there is ample justification for the Reserve Bank to have held on to the interest rate policy rates as they did. So I do not think that, and not many people, I mean, out of the 32 economists polled by the Bloomberg agency, 31 predicted interest rates to not move, unchanged, to be on hold. So I think there's ample justification. What is worrisome is their stance continues to be neutral. However, their concerns, they take away from the monetary policies actually two things. One is that inflation is going up, whereas growth is coming down. And growth, this is one of the sharpest cuts that I do not recollect the last time when RBI cut GVA forecast so steeply. It's a 60 basis point from 7.3 to 6.7%. So now, if you see a high inflation and a low growth scenario ahead, that's always very difficult for the central bank or for policymakers to navigate.
Your point taken. Okay, let me put that across to the other panelists as well now. Mr. Desai, should the RBI then be just an inflation targeting institution?
This is what the central government has told them to do in the monetary framework agreement. But
yes, but
as you know, I've argued again and again, it should not be. I would say much more precisely, I would have argued that the monetary policy framework agreement should have put both inflation and investment growth, or credit growth, whichever way you want to put it, as two key factors, and in a way calibrated it so that at the time when you're worried about growth, you place greater emphasis on the credit growth for standard that you want to put on the RBI. At the time when you're worried more about inflation, you focus more on that. But I would have put both dimensions as a goal of monetary policy. What I sense now is something very unusual. What I'm sensing is that two sets of doctors treating the economy. One sitting in Bombay, another group sitting in Delhi. And in a way, the Bombay group is not entirely confident that the Delhi groups are doing the right thing. He mentioned, for instance, inflation, the risk of fiscal profligacy and the deficit getting out of control. So I sense the unstated subtext of this is that that thing is not going to go as planned. So let us be cautious and not take chances, because the risk would be even greater if that 3.2% is violated. The point which Mr. Das
Okay,
was
sure.
making.
Priya, Ranjan Dash and Renu Kohli both want to come in on the debate and say something. So I'm going to let the lady have the first say, Mr. Dash, if you don't mind. Ms. Kohli, please go ahead, and then I'll come to you.
Thank you for the honor. Just to, burnish or add to what Mr. Desai said about inflation targeting, I entirely agree with him. And in fact, I would go to the extent of saying two things. One is that there is no debate or discussion in either Indian media or in the public policy discourse about inflation targeting and how the policy makers and the economy is in a trap of their own making. This is a trap. They cannot get out of it now.
Okay.
And the trap is very simply is that you are bound, wedded to headline CPI inflation, nearly half of it, which is not under your control. It's amenable to supply side factors. And to get out of it, you have to damage your credibility. So you have no choice except to go forward. And that's exactly what is happening.
Okay.
So, this trap is not being talked about. Inflation targeting is not being discussed. And the discourse is entirely omitting. This has been accepted and gone down across public policy discussions completely.
Okay. Yes.
So,
yes, Mr. Dash.
This is a trap of our own making, of the making of policy
Your point
makers.
taken. Your point taken. Yes.
The efficacy of monetary policy alone in inflation targeting or keeping inflation under control.
Under control, yeah.
That is, I'm not talking about that. What, as I see it, what Dr. Desai was mentioning a while ago, I do not see, this trade-off between growth and inflation is an artificial one as I look at it. That is actually, both are complementary. You cannot expect good economic growth, a high economic growth, unless you have your macro parameters under control. That one of the key factors is inflation. So inflation, price stability is an essential condition of growth. So inflation targeting or whatever, controlling prices, stability, actually aids growth. They are not contradictory. So if the central bank or the monetary policy, in fact, I would say both the monetary policy, fiscal policies, other policies should all be targeting inflation, because that is growth complementary. It is not something that is a trade-off between inflation.
Fair enough.
So having said that, I would just like to say, just comment on this, the growth projections that are now being made. She's quite right that it's been scaled down so sharply. But, even after this scale down, the projection that has been made, doesn't look very credible. Mr. Sharma said that Reserve Bank of India is always correct. If they are wrong on inflation targeting, they haven't been very good at targeting growth either. That's empirical. We know that. And this time, now, what is the situation today? For 6 quarters, it's not 1 quarter, that you've had deceleration. You have slowed down. So the latest being 5.7%. Now, what Reserve Bank of India is now saying, which Mr. Sharma also discussed, is that, in the 3 quarters, you will have over 7% growth. That means what is on the slowdown, the deceleration, that must be arrested. There has to be a sharp V-U-turn,
yes,
which is, not realistic to say the minimum.
Mr. Sharma, you're suggesting that there could possibly be a growth of over 7% in the next 3 coming quarters. Where do you think this growth is going to come from?
Firstly, there must be a good transmission of the already repo rate reduced during the last quarters, because the transmission is not good. The method MCLR is not working well. That is the marginal cost of funds lending rate. That is not effective to transmit the whole reduction by the Reserve Bank of India in the repo rate. So that should be reworked and according to the economic requirements. So second is to focus on the stalled projects. That is very, very important, because now the infrastructure is not getting that much pace, particularly in the stalled projects. In the states which are poor in the infrastructure level should be seriously focused for the infrastructure improvement. That will help the exporters to increase their competitiveness in the global market and to meet up their order books. So that is an important thing. For the infrastructure and the export growth, and thirdly, reviving the manufacturing sector. For the manufacturing sector revival, there is a need to focus on the MSMEs, ease of doing business for the MSMEs.
Okay.
That will help to increase the growth numbers in the industrial sector, and that will help to increase the overall growth trajectory for the Indian economy.
I've got 4 minutes left on the program, so I'm going to ask all my guests to be brief now so that all my guests can have a final say on the program. Mr. Desai, is it right to say that the economy is witnessing a slowdown at the moment?
It is.
But it's not all bad.
No, it's not. I don't think the economy is in ICU, but it's not well. I wouldn't put it in that category of ICU, but it's certainly not well. 2 quick points. Yes, Mr. Das is right that price stability is good for growth. I would also suggest that growth is good for price stability. It works both ways. Second, the real rate of interest we should be looking at is the difference between the marginal lending rate faced by the borrowers and inflation. And that is certainly about 2% right now, because as you said, the marginal lending rate is not 6%, it's significantly higher than that. So there are 2 things. On the growth front, I would say that the projection of 6.7% implies that we'll go up from 5.7 by more than a percentage point. More than a percentage point up. Now that looks a little problematic, frankly, with the other data that we have on IIP and the PMI numbers from the index and so on. So I would say I'd be cautious, and in that sense, I would have liked to see a slightly greater weight given to the growth imperative.
Okay, fair enough. You know, the global economic activity has strengthened, Ms. Kohli, but the Indian economic story is not the same. What's really pulling it down?
Very interesting question, and very apt one, I must say, because if you just relate this to what the RBI has said in its monetary policy statement and its growth assessment, it has pointed out pretty much what everybody has been saying, that at a time when there is a synchronized global upturn, India's exports haven't done as well as the rest of Asia, in particular, you know, countries like Cambodia, Korea, South Korea, Vietnam, Bangladesh, etc. Coming to the cyclical upturn, they are hopeful that there may be a cyclical upturn. They are unclear whether it is still not clear whether, you know, decided whether it's transient or structural, the slowdown. But they do not see any driver, actually.
Okay.
They have said that investment has been hurt much more, already more by GST. It was already weak. They have said about consumption demand, they hope that, you know, pay revision, award, etc. of civil servants may boost or support consumption.
Okay.
At the same time,
I'm sorry to cut you short, but I'm running out of time. I've got 2 more comments on the program to slip in the next 1 minute. Mr. Dash, festive season around the corner, is that going to pick up demand?
It's not. You know that the demand continues to be sluggish, and there is nothing that is really going to boost demand. That's the real problem, actually. The real problem is low demand in the economy. That has happened because of the past monetary tightening.
Okay.
Okay. And so what the monetary tightening did was actually squeeze demand, and demonetization accentuated it because all the money went to the banks, and from the banks nobody is borrowing, so money is not coming out to this thing, and that's not because of interest rate, because balance sheets are so bad, both the bank balance sheets and the major corporate balance sheets.
So, Mr. Sharma, closing comment on the program. Yes. Should the onus then be on the banks if the RBI is not reducing the rate, for the banks to reduce the interest rate and pass it on to its consumers?
I think that will be beneficial for the banking sector also. That will increase the credit growth in the banking system, and win-win situation for the consumers and the banks and for the economy to pass on all the effect provided by the RBI in terms of repo rate cut should be provided to the consumers, actual consumers. That will enhance the economic growth trajectory in the coming times.
Okay, fair enough. On that note, then we'll call This edition of The Big Picture. I'd like to thank my guests Nitin Desai, Priya, Ranjan, Renu, Kohli and SP Sharma for joining me on the program and putting things into perspective for us. That's all the time we have today. See you again next time.